Welcome back to Advus After Hours, a podcast focused on the intersection of innovation, finance, and community. Today, Jeff and I sit down with Tom Sittema and Neil Menard, partners at StepStone, a global private markets firm managing over $134 billion in assets. Tom serves as the firm's executive chairman, while Neil acts as the president of distribution. Individually, Tom and Neil have decades of experience in the investment industry, but alongside their work in private markets, the two are heavily involved in the Central Florida community. Tom and Neil, appreciate you guys being on here. This is at least pretty cool for us because he worked with both of you. I know you grew up playing hockey with my dad, so I definitely want to touch on that. Well, why don't we just start there then? I hear a ton of stories about how my father used to be quite the instigator and would start fights, take a step back, and let the bigger guys take over and handle that. Can you confirm that story?
100%.
Yeah.
He is very, very good with his stick. And I'm not talking about with the puck. I'm talking about where he put his stick. Right. And he was always surrounded by bigger guys. So he was a smart man.
So that's accurate.
It's totally
it's
accurate.
Good to know.
Yeah,
and how far back does that go? We're talking middle school, high school?
Whatever 13 is, 8th, 7th grade.
Yeah.
So this is all new to me. I had not.
So Mark and I were counselors at Providence College hockey camp when Lou Lamorello, Mark's uncle, was the coach. Lou is now the GM of the Islanders, and he's won Stanley Cups with the New Jersey Devils. He's Lou is a legend. But talk about a guy we were scared to death of, both of us, and we both had to go in and ask him if we could do leave camp because as counselors to go play summer hockey against each other. And I'm like, you ask him. He's like, I'm not asking him. You ask him. I'm like, he's your uncle, dude. I'm like, come on. So we finally, we mustered up the courage to go in and say, hey, Lou, can we have the night off so that we can go, play summer hockey? And we got the lecture like, boys, you're here to work. You should have thought of that before you took the job. And we're both like, oh, crap, he's not going to let us go. And he finally was like, all right, go. So we literally went, played summer hockey against each other and came back.
Who won?
I don't remember. But I'll bet he does.
Yeah.
But I don't remember. I really, truly don't remember who won. But I remember, going to the Smithfield rink, which was probably 15 minutes from Providence College. Played each other and went back.
Where in Rhode Island were you from specifically? You were like northwest.
I grew up in a little town called Burrville, Rhode Island, which is kind of in the northwest corner of the state. It's a little state, right? So
did you hear that? It's kind of all rolled into one.
Burrville.
Right.
Sorry.
Ours aren't the strong suit of those.
No. Yeah, so little French Canadian enclave in the northwest corner of the state, and my parents French Canadian. My grandparents moved down from Canada, working at textile mills, and we were this little town, this little public school, but had our own rink, which was amazing, right? And this little town that didn't have anything, right? We didn't have a McDonald's, we didn't have a Dunkin' Donuts, we didn't have anything. Right, so I went to boarding school. So I left Rhode Island when your dad was at Hendricken, and because it's a long story. I won't get into it, but I went to boarding school, and then I was working for SEI Investments in the early 2000s, like literally 2000. I was the wholesaler in Florida, and I had a list of advisors to call on, and Mark Lamorello, like can't be. So I picked up the phone and called him. It's back when his office was downtown. Hey, Mark, I was looking for Mark Lamorello, and they screen, and as I finally get to him, and I'm like, hey, this is Neil Menard. Is this Mark Lamorello? And he's like, oh my God. So he's like, come on in. So we reconnected, and I think it was 2000 actually, if I'm not mistaken.
So I'm going to let each of you get into your backgrounds shortly, but I want to start with probably one of my favorite stories that involves all three of you about Jeff's time at CNL. So I don't know if this is going to get you in trouble or not, but I want to let you tell the story.
Yeah, I'm not sure if either of you remember this at all or not, but it was actually a great story. And right when I started,
this is always a little scary.
It doesn't. You guys didn't do anything.
CNL, you guys were great. Everyone at CNL was great. It was probably first couple weeks on the job. It was myself and my buddy Andrew Sciano, now at Starwood. Not sure if you remember him or not, but we were the two sales associates. There was this marketing system online, this software we used, and you had to type in this little algorithm to make sure it came out correctly. I had a couple guys on the desk training me up on it, how to type it in. I thought I had it nailed down, typed it in, pressed send, went to the bathroom, come back. The sales floor is lit up with everyone on the phone, emails going crazy. And I had no idea what was going on until I sat down and realized I accidentally sent a email blast to the whole database, 250,000 people across the country. Every advisor basically got invited to a happy hour in Las Vegas. So not only did they get invited, but they all thought we were flying them out to Vegas. There's guys in Georgia calling in and calling their wholesaler all excited, like, oh, can't believe you invited me to this happy hour. Thanks so much. We actually ended up getting a lot of meetings out of it, and we were able to resolve it. But the rest of the day where y'all come in was everyone was just being so nice. And the culture there was, telling me it was going to be okay. It wasn't the end of the world, even though it kind of was. And then by the end of the day, you two come around, and Neil was the one who he looks at me, looks at Schiano, and he looks at Schiano and says, this is the point where you're teeing off. The guy in front of you shanks it into the woods, takes all the pressure off. And then that's how I started. And then I think you walked away after that. But it was great. And everyone was cracking up.
That's about right.
And that really was what it felt like at the time. It's kind of a core memory I still have from my young career. But I appreciated you guys in that moment.
So Tom, why don't you just tell us a little bit about yourself, your upbringing, your education, and what you got you to the point that you're at now?
First of all, what a delight to be here. So thank you guys. We have just huge respect for your firm, and Mark is way more than just being one of our partners. He's a thought leader, and we when we're going to roll out a new product, we couldn't imagine rolling out a new product without sitting down, and we've done that with each of our products and said, hey, how do you think? So anyway, thank you for that. So my background, I grew up in a family, 2 parents. I had 3 brothers. I have an identical twin brother, which is sort of an interesting background and some just awesome memories. Grew up as my best friend, probably still is. 2 older brothers. I grew up in the south side of Chicago, in an area that today you don't really want to drive through unless you have a sort of a bulletproof vest, probably. But not a very safe neighborhood. But when I lived there, it was fantastic, sort of immigrant central, where all the different ethnic groups sort of lived adjacent to each other, and there was it was just an awesome place to grow up. Very, very middle class kind of family. My parents had no financial means, but we didn't know we lacked nothing, kind of thing. And went to mostly faith-based schools. I'm a faith-based guy. My family was really deeply religious. Went to a small Christian college in Northwest Iowa in the Midwest area, and met my wife there. She grew up in New Jersey, sort of similar background. I'm Dutch, and there's a lot of Dutch sort of history and legacy in this school, and where I met. Went from there to graduate school at Indiana University and got an MBA there, and got married right coming out of college. So I was one of those guys married at 22 years old. And when I look back, it's like I just can't even imagine. I got married that young, and we ended up having kids, not planning. It just kind of happened.
Right.
But so we had kids right away. And then I started my career in Dallas, Texas. We sort of said, if we're going to start a career and move anywhere, where should we move? Because we always thought we could move back to family,
right,
once you had kids, but pretty difficult to have kids and then move away from everybody. So we said, let's just on a flyer, let's go to Texas. And, Dallas was rocking.
Mm-hmm.
Started my career in real estate banking, and just thought it was, I mean, I was loving every minute of it. Real estate, a lot of the community leaders of most cities in America have real estate backgrounds because they have a gift of deal making and vision and strategy. So I was learning some of that and ended up joining the real estate group and just learning underwriting. And to this day, I'll pull over and looking at real estate on the side of the road. When my kids were young, it's like, Dad, please, no more real estate. Can we just go home or can we just go eat or whatever? But we lived in Dallas, Texas for a dozen years, have 3 children who are all grown now. They're all born there. I moved from, I felt shackled by sort of a regulated industry and moved to a less regulated industry, which was investment banking, and moved to Charlotte when we built a real estate related investment bank. And so I did that for 16 years in Charlotte, just doing sort of IPOs and M&A and debt and equity capital raising and that sort of thing. Through that, I got to meet some folks here in Orlando and then had an opportunity to move here to lead a business and succeed a founder. And so I did that for a number of years. So we moved here at the end of 2009, sort of tough time to lead a predominantly real estate oriented company. And did that for a number of years before we've launched what is now StepStone Private Wealth.
So Neil, we touched on your upbringing a little bit. Let's dive in a little bit more, but also, when did you two meet? You and Tom, was that at CNL or was that prior to that?
No, so we met before. I think I knew Tom for probably 5 years before I joined him at CNL through the business, right?
IPA
I mean, just through the
like
business.
that.
We'd be at a conference together. We're speaking at the same time at conferences, and we'd run into each other and chat and get to know each other. And well, we said, someday we have to figure out how to work together, and it all came to fruition over. It's a pretty funny story.
Let's hear it.
Tom calls me. So back up a little bit. So I was living in DC in Maryland in Bethesda, just outside of DC, and moved down here or back to Orlando with my family because we wanted to live here. Not because I had a job, and we really enjoyed just being in this area in Central Florida. So I get a phone call one day. He goes, "Hey, I heard you moved back to Florida." I said, "Yeah, I moved into Winter Park," and he's like, "So, what are you doing?" I told him what I was doing at the time, and he's like, "Well, let's have dinner." And I said, "Okay, let's have dinner." And so we go to, I don't remember the restaurant.
Before Real Fish, it was Ravenous Pig.
Ravenous Pig.
There you go.
Yeah.
So we go in. I'm meeting this guy, for dinner, and we're going to talk about potentially working together. And he's the CEO of a big company in Central Florida. And we sit down and we order drinks. I order wine, and I think we ordered a bottle of wine, and they brought wine glasses that were like water goblets. I mean, they were like this big. And I just kind of looked at the waitress. I'm like, "You must have better wine glasses."
Right.
Actually, the quote was, "I'm sorry, do you have real wine glasses?"
That sounds about right.
So I started my interview for my new job.
So I started laughing. It's like, okay. He's a little bit of a wine snob. It actually doesn't really matter how good the wine is as long as it's in a big goblet.
That's right. I want a real glass.
Right.
So anyway, then we started kind of our career and partnership together there. I mean, Tom's been a friend, a mentor, a boss, and now a partner for, I guess, the last, call it 9 years. Crazy. Yeah. It's been that long. Yeah. Holy cow. And we had a shared vision, and we had it in our previous employer, but we couldn't really execute on it. But we had a shared vision, which was to build an alternative investment platform from the investor backwards, right? So think about something that the terms we use are kind of convenient, efficient, and transparent. All the things that previous products weren't. Right.
Yeah. Right.
And so we really had this vision, really wanted to execute on it. And we realized the only way to execute on it is to go off and do it on our own, which was a little risky.
I will jump in and say, when we finally came to the decision that it's time for us to work together, he came over to the office. We sat in a conference room and we cut a deal over compensation, role, all that sort of thing in about 10 minutes.
Really?
It was, you remember
it was
that?
easy. Yeah, I do. No,
And it was sort of like, hey, what do you think is fair? This is fair. Okay. How about this? Yeah. I mean, it was like, and largely because we had built a very, very high level of trust between us. And it was, we didn't have a 60-page contract. It was sort of, we were just trying to figure out what was the right answer for the other party, which is sort of a business principle that we've continued to operate with.
Yeah. And Jeff, you've heard this before, right? And the relationship transcends the transaction, right?
Yep.
The relationship is so much more important than the transaction.
Yeah.
So if you do what's right for the people, things are going to go right for you in the long run.
I love that. So before we dive into what you're doing now, you said it was a bit risky.
Both of us are entrepreneurs in sort of differing senses of the word. And both of us had a vision of where this business needed to go and where we felt like it was going to go. And we wanted to help accelerate the movement in that direction. And there was a number of secular trends that we saw in the market back 10 years ago, and we still see them today, and it's only accelerating today. So we got together and when we launched the new business, I mean, we all were sort of kicking around a lot of different ideas, and it was sort of like there's only one. When you talk distribution in our business, there's hundreds of people that are distribution professionals. There's only one that I'm going to ever partner with. It was a very short conversation, and Neil and I were going, yeah, we're in. Let's figure this out.
Mm-hmm.
So we have two other partners, and what's unique about the four of us is that we all have distinct skill sets.
Right.
Which I think is rare, and when you bring four people together. So I've been in distribution my whole life, my whole career, like literally from the day I stepped out of school, not on purpose, but that's.
So was that your first job? I think we skipped over that.
Jeff, I got out of school. I was just like you. They didn't think they called them analysts back then, but whatever they called them, right? And I quickly moved into an internal sales role because I was just like, I love what those guys are doing. They're on the phone, they're talking to people. It's like the conversation's interesting. I wanted to do that, and I did it, and I was selling maybe, the worst thing you could sell as an internal, fixed annuities and then some variable annuities. Right. And so my kind of career advanced that way to so think from 1989 to 2006 was kind of traditional investments, right? Stocks, bonds, cash, always on the wholesale side, through financial advisors to their clients. And loved it. I loved every minute of what I did. And in 2006 is when I moved to the dark side of alternatives, and ran a business that sold alts, same model, same distribution model. So got to build a team there. And what's interesting about that, and we talk about relationships. What's interesting about that is that my best salesperson at that role, and from 2006 to 2014, now runs my sales business at StepStone Private Wealth.
That's cool.
He's come with me, and he's, by the way, the best, regardless of what Tom says. So my career advanced that way. So I went from being an internal wholesaler to an external wholesaler. Then I went on to being like a regional manager and a national sales manager, then head of distribution. So 2006 on, I've run distribution businesses for all size companies, big, small, and now big again.
Yep.
And this one's global, which makes it different.
Yeah, so I want to back it up just a little bit. Typically, you don't go too into the weeds on a financial topic, but I want to get your opinion as to what you think a true alternative is, because right now it's really just a catch-all for anything that's not a stock or a bond. So give me your opinion, one of you, either of you, as to what you think a true alternative is.
Yeah, I would say the way we think about alternatives, we use alternatives and private markets, sometimes largely interchangeably, but we think about alternatives as one of four major asset classes within the private markets business. And it starts with private equity, broadly defined private equity, which goes from early stage venture capital to large cap buyout, all sorts in between. So private equity is the first. Infrastructure, all things infrastructure. It could be toll roads, airports, ports, telecom, cell towers, transitional renewables, energy,
Data
that
centers.
sort of thing. The third asset class would be traditional real estate, private real estate, not public REITs, but private real estate, typically it could be a private REIT structure or direct real estate, which also could include real estate credit. And then the fourth is private credit. And private credit today could be a BDC structure, it could be some other form, could be an interval fund, but private credit, not to be differentiated with or confused with public credit. Those four asset classes are how we think about alternatives or private markets. Some will throw in commodities or certain kinds of hedge funds and that sort of thing. We generally don't go there. We focus on sort of the four major asset classes of private markets.
And just to expand upon that, I think correlation becomes an important factor in when you're talking about alternatives, right? So not necessarily, it doesn't have to be non-correlated, right? But less correlated to the public market. So think about, the times of high stress in the public markets, private markets generally outperform dramatically, in fact. So that correlation factor, it's not following the herd. It's just kind of doing its own thing. And that's really, I think it actually provides a great experience for the investor.
Well, I think the past year is really a true testament to that, where equity markets and fixed income markets kind of moved in tandem with each other. And the conservative investor who was in a traditional portfolio, didn't have alternative investments, really felt a lot of the downside. And it was an uncomfortable experience. And so I guess the next question, and again, this is really foundational, is most people aren't familiar with your segment of finance, but what would you say are some of the strengths and some of the drawbacks of investing in alternative investments or private markets?
So I'll jump in, and I know Neil will have some comments, but I feel compelled in answering that question to say that oftentimes we'll speak with financial advisors or firms or we'll listen. We went to a luncheon a month ago and listened to a very sophisticated platform and a chief economist talking about the 60-40 portfolio, stocks and bonds. And we raised our hand and said, can you remind us when 60-40 was designed and implemented? And he was, thinking and said, I don't know, maybe 50 years ago. We said, like, before the advent of private equity, before private credit was created as an asset class, before infrastructure even existed. It's like, why would you call it 60-40 as an option unless you're going to use an abacus instead of a computer or a calculator? It's sort of good. It's so outdated in our opinion, and the size and scope of the private markets relative to the public markets is so substantially larger that to exclude the entire private markets from your asset class allocation to us is such a fundamental mistake that investors are really sort of missing the whole market.
Well, that's exactly it, right? So the challenge with what we see or what investors see, because we know but what investors see on TV represents about 10% of the U.S. economy, right? 90% of the U.S. economy is private companies, right? So if you're not investing in private companies, you're missing out on the largest segment of the U.S. economy. And listen, frankly, most people don't know, even to your point, don't understand what we do, right? And yet it's like the biggest driver of our economy. It's the biggest driver of the innovation in our economy is private equity. So not tapping into that, limits your investment options dramatically.
Yeah, and the 60-40 is used as the benchmark for comparison, at least in most publications. Why is it, in your opinion, is it accessibility as to why private markets or private investments aren't used in comparison?
Great question.
I think part of it is lack of education and understanding. There's a lot of people that say, I've never invested in private equity. I don't really understand it. I'll kind of stick to what I know. It's sort of easier. I think the whole lack of understanding and education on the asset class. I think secondly, and this is a criticism of the private markets, until very recently, the last handful of years, the nature and quality and caliber of the investment offerings in the private markets were suboptimal. They were oftentimes not institutional quality sponsors. They might have had misaligned fees where the sponsors, sort of heads I win, tails you lose kind of thing in terms of structure. All of that, we knew that was going to change when we started our business, that the rate of that change has accelerated dramatically. And it's led to a very significant accelerating growth in this asset class for sure.
Yeah, I want to expand on that, but I want to come back to a point.
Yeah.
But so this idea that we talk about the democratization, right? I don't think we're democratizing alternatives. I think we're institutionalizing retail alternatives, right? And retail is a bad term too, right? Because high net worth investors are not retail investors, but in the institutional world, that's how they reply to them, right? So we're institutionalizing, to Tom's point, the sponsors that are now providing alternatives for high net worth investors are some of the best sponsors in the world. It's changed in that sense that the access is being provided by higher quality managers delivering higher quality product at the right pricing for the retail investor. So that's a good thing for everyone, frankly.
Right. Mm-hmm. So that's essentially what you guys started your business on, right? Is that growing popularity in alternatives, coupled with trying to make them more accessible. So can you speak on that a little bit?
No, 100%. So let's go back to what you originally asked, Mitchell, which was, so why aren't more retail investors invested in alts, right? And accessibility was a big one, right? So very hard to get. The opaqueness of alternative investments, it's investing in a blind pool, right? And especially in private equity. Like, what am I investing in? I'm going to give you capital calls, right? So I'm going to commit $1 million to private equity, and I don't know when they're going to call the capital. So I got to leave it in cash. Well, why would I want to do that, right? K1s, right? A K1 in every state in which you buy a company that comes in October. So, it's extension. So until we solve for those problems, it was going to be very hard for the retail investor to access private markets, right? And what we set off to do was solve every one of those problems, right? Is to make the experience, remember I said convenient, efficient, and transparent, make private markets accessible to high net worth retail investors in a way that they can access it when they want to access it.
I would add two more to what Neil just said, is diversification. The products that historically had been available not only had all those features, but it was a single sponsor, it was a single strategy, it was a single vintage year fund. It might have had a dozen companies or something in it, but it was not diversified in any respect. You could have a great sponsor, but it had a bad vintage year, or you had a good vintage year, but not a great sponsor. So you didn't have the benefit of diversification. We wanted to add really broad diversification across the private markets. And then the other thing we really were committed to and still are committed to is open architecture. The whole concept that somebody who is really, really good at buying U.S. focused middle market healthcare companies, given all the transition going on in healthcare, may not be the same people you want to invest with to buy apartments, or to buy a European mid-cap buyout or a venture. So you want to invest with sponsors in their sweet spot, in their power alley, and combine that with investments with other sponsors in their power alley. And that's how you're going to find alpha, and with broad diversification across the portfolio.
Here's the pushback I get from a lot of clients who are individual investors. We'll call them retail investors. And they feel like by being an individual investing in private deals, they are simply getting the institutional leftovers, right? Companies only need to raise so much capital, and they feel that the institutions utilize all that capital, and they're getting all of the leftovers that the institutions do not want.
That is actually 100% a legitimate concern, and it actually is a concern spoken by more perceptive investors. When we set up our business, we dealt with that from the get-go, and we have in the products that we offer, we have it's called exemptive relief from the SEC. Every investment that we make across our entire global footprint, where the investment fits the investment strategy of our funds get to raise their hand and say, we want in or we don't want in, but there's no adverse selection at all whatsoever. And if we want in a fund, we invest side by side with the largest institutional investors in the world on identically the same economic terms that they invest. Mm-hmm. There is absolutely no way for individual investors in our firm to be disadvantaged or to get the leftovers or in any way have deal selection sort of result in an adverse selection where the best deals go to institutions. Mm-hmm. That's not, that is impossible in how we've set up our business.
Great point.
Yeah, I think that's going to be a huge relief to individual investors who are interested in investing in private markets, because I know it's a huge concern of theirs, but we could continue to pepper you guys with questions on this.
Yeah, we could literally talk about this all day.
So can we.
Yeah, so I think a lot of clients, prospects, family, friends are incredibly interested in this segment of investing, but it just seems so inaccessible to them. It's foreign. There's a lot of terminology. It doesn't always make sense. So I really want to move into the innovation portion of the conversation and talk about how, since you all have been in the industry, right? You've been in here multiple decades in private markets and alternative investments. How has the industry innovated itself over time?
I think it's what we said earlier, right? Which is we've seen this kind of institutionalization of the market. Mm-hmm. All of the right things have happened, which is, again, as I said, it's good news for the industry, which is fees have come way down, right? And we've been in this business long enough to where the sale used to be 7% to you, 7% to your client. How many kits do you want, right? Well, you can't pay commissions of 7% and expect to deliver returns to the investor, right? So fees have come way down. Commissions are almost gone, right? Your business is 100% fee based. You work on the side of your client, right? And the business has gone that way, right? For 100%, 100 times better than what it used to be for the investor experience, right? The information, the education is dramatically better than it's ever been, right? There's more. Well, first of all, people have more access to information than they've ever had, even on the private markets, right? I mean, let's think about the headlines we see every day. But I think the information that people have to do research, even on private markets, is tremendously grown in a way that's very positive for them as well. So we want. I mean, the easy answer for us is we want educated investors, because if they understand it, they're going to stay in it. They're going to buy more, right? So we're going to help them understand.
If you look back at the sponsors that were in this space offering private market products 10 or 15 years ago, and then you look at these sponsors today, those sponsors don't even show up in the top 25 in terms of market share. The list of sponsors today are the who's who of the best platforms that invest in private markets. So that's a complete sea change. So as Neil pointed out, we've not only seen a dramatic improvement of the nature and quality of the offerings and the structure and the user interface and the sort of the client-friendly structure. You've seen much better sponsors and product offerings. The other thing I would say is there's a general lack of understanding. People think of private companies and they think of startups or they think of smaller companies.
Right. It's a classic venture capital.
Right. Yeah, it's a high risk kind of deal. We do business we invest in private companies that are billions of dollars in size, that have hundreds of millions of dollars in annual sales. if you look at the growth rate of a lot of the private companies that we invest in, it is substantially in excess of the average growth rate of even the fastest growing public companies, because many companies used to 10, 15 years ago, they would raise private capital and then they would go public maybe when they were 100 million or 500 million in size. Today, you look at it, and Uber is one that we always use. They stayed private with massive rapid growth and went public at almost a $50 billion value. So many private companies are staying private for years and years longer than they used to, with dramatic growth and value to the stage investors. And then when growth is leveling off, then they go public.
Yeah. I mean, the simple soundbite, right? I mean, the access to cash for those companies has grown dramatically while they're private. So the value creation for the investor happens while the company is private, right? I mean, and you go back to Microsoft. Microsoft was only private for 18 months and then went public, right? So the change has been all of the value creation for the investor came after they went public. How much more can Uber grow? Right? I mean, or Grubhub, pick one.
Right.
These crazy name companies that are worth billions and billions of dollars, and they go public, and I mean, how much more can they go up?
So I think this is something you guys are doing well in your business that I wanted to touch on. I think as a younger guy working in alternatives for so long in my younger career, at first, I was all about democratizing alternatives, getting more access to more people, and bringing that further and further down, the food chain, so to speak. But I think, as I've gotten older and seen more examples, it's kind of come full circle for me with the need, to have those certain protections in place around liquidity, and what that looks like for investors being more sophisticated and that kind of language. And so I think you guys do a great job of kind of that middle ground there. So speak on that a little bit and what that looks like for investors as far as that accessibility.
Well, look, the early vintage of this 10 years ago, there was zero liquidity. Somebody would invest and it could be 6, 8, 10, 12 years. There was no liquidity whatsoever. When you started to have the opportunity to invest in what we call a drawdown fund, where you're having high minimums, single strategy, single sponsor, single vintage year, no liquidity in those products either, but they were not sold with any liquidity. They was sort of like, your money is locked up. It could be 6 years, it could be 8 years, it could be 15 years. You don't know. The products that we're now offering have what we call semi-liquid or limited liquidity, typically limited to somewhere between 10 and 20% of the aggregate NAV of the fund, net asset value of the fund, annually, and we'll offer that quarterly. So if it's 20% a year, it's 5% per quarter. And we always say these are longer term investments. You would not invest in the stock market prudently and put a bunch of your money in if you think that you're going to need the money in 6 months or a year. Or nobody would advise you to do that. And you shouldn't invest in the private markets with that mindset. We always say these are longer term investments, 3, 5, 7 year investments. But nevertheless, if you want liquidity or need liquidity, you have that option in our products at the net asset value, not at a massive discount, at the net asset value. So it is, you should not invest in these assuming that it's a money market where you can punch in and punch out, but you wouldn't invest in the public markets in equity with that mindset either, unless you expect to get burned.
Yeah, we've had clients worried about that, where they're like, what if I need, liquidity and I'm in private markets? It's like, well, it's a small piece of the portfolio. If we need liquidity from that piece of the portfolio, we have much broader issues.
Right.
Issues.
Right. Well, 100%.
Yeah.
Listen, in it like anything, there's risk in any investment, right? And I don't want to sound like the compliance guy, but it's true, right? I mean, it's the reality of the world that we live in. You said something earlier, Mitchell, that I've been thinking about, and what you said, we were talking about the 60-40 portfolio, and you said, well, conservative investors probably don't want to invest in alternatives. I think that's flipped upside down. I think the conservative investor needs more access to alternative investments because they can't handle the volatility in the public markets, right? And if you're only invested in the public markets, and you said it, right? Stocks and bonds have been correlated to one another. By the way, it hasn't been just the last year. It's been since like 1994, right? Which is the last time we had, well, bonds are down now, but the last time we really had a bond issue, which only lasted for like 6 months, right? In 94. I got to ask the old guy because he remembers more than I do, but having alternatives in your portfolio that are non-correlated to the public markets. I'm not saying you don't need the public markets. You absolutely have to have an allocation to the public markets, but the 60-40 portfolio still works. It depends on what you allocate to, right? So it should be stocks, bonds, and alts, where it used to be and cash, right? But I think the addition of high quality alternative investments to a diversified public markets portfolio lowers the risk and increases the return and smooths the volatility line. And I think that's lost. I think that's lost in regulation.
So that's kind of what I was getting at there. I think we can talk about alternatives all day. We're clearly all very passionate about that. But getting more back to the personal side, this is very much a niche industry in the investing world, at least. And, we've touched on this a bit, but what made you guys so passionate about this industry enough to kind of stake both your careers on it?
So I think I was telling you guys I was in Greece the last week, right? And with like 3 days left in my vacation, I was texting Tom, calling Tom. He's like, I thought you were on vacation. I'm like, I got to get back in the game, man. I can't. we love it. I mean, we love it. We live it. We live it every day. We love being there. We love being in our office. We love the people we work with. We love helping you guys, right? We love being a solution. And maybe I'm speaking for me, but we get up every day, man, fired up about what we do and trying to find ways to improve the experience for the investor, right? We started this business, like I said earlier, with the investor in mind, right? And we're unlike the way the business used to be run, which was okay, we're a sponsor, we're good at this, we're going to build a fund and convince everyone they should invest in that fund. We started with, what does the investor need, right? How do we make it easy for the investor to have access to these funds? And it's in our core values, man. This is what we do every day, right? It's our mission, and it's something we're obviously very passionate about.
The blessing that we have, and private markets maybe are not for everybody for a career, but the blessing we have is we love what we do. We love who we're doing it with. And when you have that and it's aligned with sort of your passion and your gift mix, it's kind of not work. It's like we joke all the time that we're excited to go to the office. We have fun in the office. We laugh. We have a very high intensity in terms of our work culture. But we want to have fun, but we want to get a lot accomplished, and we have a very high standard that we set first for ourselves, and then for sort of our expectation for our company. And for us, it happens to be in the private markets. Other people can work on cars or other but if you're able to match your passion with your skill set and with a group of people that you have deep respect for and admiration in a high integrity, sort of high performance culture, it's like that's everybody's dream for a work situation.
I think that's a good segue into kind of what our passion is here on this podcast, right? At the intro, we talk about how we meet people at the intersection of innovation, finance, community. We talked a lot about finance. We talked a ton about innovation. So I want to move into the community aspect and talk about how, Tom being from Chicago, Neil being from Rhode Island, both of you having very finance-centric career paths that typically lead you to Northeast, but you both settled down in Central Florida and you built your families here. So tell me what you love about Central Florida, what makes Central Florida so appealing to the both of you.
I moved here in 2000 initially, or maybe it was late 99 initially with my family for a job.
Mm-hmm.
Right. I was working for a company that moved me here into Central Florida. And by the way, we could have lived anywhere. We moved here initially because my wife's best friend from Massachusetts high school was in Maitland, Florida. So yeah, I was going to be on the road 4 days a week. So I figured if I plug my wife and my 3-year-old in next door to her best friend and their 4-year-old, pretty good move. Right? And it turned out to be a great move.
Yeah,
Good strategy.
Yeah, I'm smarter than I look. But anyway, we left, right? So we were here for 6 years the first time. We left, and in 2013 went through a financial planning process, believe it or not, and together, and where we were separated, we had to like do our own goals and then bring them together.
Yep.
And we both wanted to live in Central Florida, and weren't talking about it.
Interesting.
Assumed she was happy. She assumed I was happy, and living in Maryland, and we were. By the way, it's a great place to live.
Mhm.
But really wanted to be here, raise our kids here, and frankly, I'd tell you, when it came to moving back and why we wanted to, it was really my son. My daughter was a senior in high school when we moved back, but my son it's just to plug him into the values of the people that we knew in Central Florida, right? And the school he went to was values based, and really, that respect element, I think, is lost in places, and we really, that was really important to us, that he be plugged into people who were, where respect was demanded, and expected of them, and there were no excuses. So we moved back here. Like I said, I wasn't for a job. Just moved back because this is the part of the world we wanted to live in, and plug into the community we wanted to plug into.
Yeah, I didn't know about that gap. I think that's the most telling thing to me, is that there was a period of time where you left and then came back.
Oh yeah, 6 years. No, we were gone for almost 9 years, and came back. Like I said, just really, for really the call it lifestyle, makes it sound like whatever, but for the lifestyle,
Right.
I mean, it really is for the lifestyle.
And Tom, you were in
That's cool.
Chicago, Texas, and then
Charlotte,
and then you made your way back to Central Florida.
So I came down, maybe a little bit different story than Neil, same ultimate ending. So I moved down here for a job. I remember my wife specifically saying, look, I think you're going to love what you do there, and I think we're going to tolerate living in Central Florida. And I go,
A lot of
sweetheart,
people say that.
I hope it's way more than tolerating, but there's I think a misperception about Central Florida, and particularly Orlando, as a tourist city and maybe an older population and hot and blah blah blah. Well, we had lived in a lot of other places. The weather here is better than any of the places we've lived. The caliber of the people. Winter Park, where we live, is a gem on the whole East Coast that is not very well understood. We've been here 13 years. Maybe this is the most important statement I can make. I have 3 kids I mentioned. They're all married. They've grown up. I have my 12th grandchild on the way. I have 11 grandkids, and they live in the Carolinas, and we're not moving back anytime soon. Probably never. And so we spend a lot of time traveling to go see them, and they come down here. In fact, my youngest daughter and her family are coming down tomorrow to spend a week at the beach with us and so forth. But we love this community and all the things we've talked about. It is a really special place. Neil touched on sort of the values-based. It's just, there's just a genuine respect for the individual. There is, I'm a faith-based guy. There's plenty of opportunities for that. It permeates a lot of the culture here. The business community in Central Florida is just a really, really special place. It's home.
So we've talked a lot about Orlando, but Tom, I wanted to talk more about one of the bigger projects you started and co-founded, which was Lift Orlando. So tell us about that, because I think it's been massive for the Central Florida community.
Well, I could talk about that for a long time.
Plenty of time.
So Lift Orlando is an effort. It's a nonprofit started about 10 years ago here in Central Florida that focuses on really making, hopefully, permanent transformation in the lowest income zip code in Central Florida. And that particular zip code is just outside of downtown Orlando, and it surrounds the area that the Florida Citrus Bowl Camping World Stadium occupies. And it's we focused on about a 1 square mile area directly around the stadium. And it started with me driving to the stadium to go to a game, having been in Orlando just 2 years and having not been to that side of town. And I was just awestruck at how deep the poverty level was. And my wife and I were just amazed. And we started thinking, children that grow up in that community have no shot. I mean, how do they have a shot? And we started thinking about sort of the conundrums. It's sort of like, this is, the city beautiful, we call it. This is the happiest place on earth with Disney and Universal and so forth. And then you see that and you just say, wow, this is just a living contradiction. So we just committed, being relatively new to the community, we just committed to sort of studying it and learning it and asking questions. And I'm sort of an instigator, and I like to ask questions. And it's like, how long has this been like this? And what efforts have been done to sort of reverse this? And you realize that, as an equal opportunity offender, I came across sort of two sort of typical responses. One is, hey, we just don't have enough money. Big government is the solution. And then you study it and say, 50 years, war on poverty, $10 trillion expended, and areas of generational concentrated poverty are worse today than they were 50 years ago. And you say, okay, well, that can't be the answer. The other side is, these kids, these people just need to pull themselves up by their own bootstraps, like I did. And you go, okay, well, what if they've never seen a mentor? They've never had a role model. They've seen families here for generations have not seen a parent get up and go to work or what have you. And you go, and they go to failing schools. Or how about this statistic? It's traumatic for most parents to move their kids to a different school. You think about that.
Right.
That's difficult. How about if you had to move your kids to a different school every year? And you go, or how could that possibly be good and healthy for your ability to learn and grow and be, socially adapting? So we just started asking questions and doing research, and we did that for about a year and a half. Started assembling a group of people that were like-minded, that had a conviction to do something different, and it led to the formation of what is called Lift Orlando. Lift stands for Learn, Identify, Focus, and Transform. That's how we named it. And so we built an organization. I am privileged to have been the board chair since the formation of the organization. We have an awesome staff and an all-world board, and we've been blessed with some really pretty amazing success stories along the way.
But if you think about this story, right? So Tom's vision was, we're going to spend, how much money did they spend renovating the stadium?
$200 million.
Yeah, so
Right.
$200 million renovating the stadium. So if you look at stadiums around the world, like when that happens, the neighborhoods around get gentrified,
Mm-hmm.
the stadiums, right?
Mm-hmm.
And I think this is exactly what you were fighting against. Like so we're going to spend $200 million renovating this stadium to attract revenue and tourism dollars to football games. What about these people?
Mm-hmm.
And I think that's just brilliant.
As someone who grew up here and seeing that neighborhood over time, it's cool to see some people who aren't even from here and take so much passion and pride in, revitalizing and changing Central Florida and this community for the better.
But Jeff, I think it's such a good point. What I didn't appreciate then, and I've come to appreciate it more, is the fact that we're not from here actually gave us a massive advantage. When I started talking to different people about this, the response that we got was, Tom, it's kind of always been that way, and I just assumed it always would be that way. And we sit back and say, but that's just not acceptable. We can do better than that. I always think we have an opportunity today to live in the greatest country, maybe in the history of the world, at this most fascinating time in the history of the world, with the greatest prosperity and liberties and freedom, and then to see entire communities that send their kids to failing schools, have no housing options, no ability to get a job or job training, and oh, by the way, have a longevity of life that might be 15 years less in certain zip codes than the adjacent zip codes. And you go, really? That's the best we can do? I don't think so. Let's figure out how we can fix this. And so we just started gathering people. By the way, we had big ideas. None of them were founded in experience or, we just started asking a lot of questions, reading books. I think we went to 13 or 14 cities when we heard certain projects or certain initiatives or efforts were underway, just to learn, see what's worked in other places, and brought that back and just started really entrepreneurially tackling sort of the problem, focusing on a vision and a business plan, accountability for results, not just throwing money after a problem, but really drive a sense of urgency is probably one of the greatest sort of characteristics of the effort is excellence and urgency. We say all the time, hey, every month that we don't get things done is another month that kids are going to failing schools or somebody is living in a car because they don't have affordable housing, or they're having sort of no access to sufficient health care. So we have this passion that we can't move fast enough, but we have to do whatever we do with absolute excellence, with a mindset that anything we do there has got to be of the same caliber and quality that we would expect for our own family. That's sort of how we think.
Yeah, I love that. I think, we could talk about this all day as far as Lift Orlando is concerned, and would love to have you come back, bring Eddie on, and really dive more into Lift Orlando and the impact it has. Do a whole nother episode.
Well, I'm so grateful for your interest. I will say maybe another, it could be the most important characteristic is the people that are leading Lift Orlando are all business women and businessmen. We don't have politicians. We actually don't have a bunch of nonprofit people. They're business leaders. And the interesting thing is they're business leaders that are leveraging their core competency, their passion, and what they do in their day job, which is problem solving, vision casting, accountability for results, whether they're a lawyer, whether they're a real estate developer, whether they have a marketing bent or a sales orientation, whether they're a strategist, whatever it is, a CPA. We have pulled people together in their power alleys, if you will, and their core competencies. And we then work together to sort of drive this agenda. And that can happen in every community in America.
So for anyone who wasn't familiar with Lift Orlando prior to this episode, how can they get involved?
So look, I'm the last guy that you would think could do this. I wasn't even from this area. I grew up in the south side of Chicago. It's like, I would be the last guy that somebody would think could sort of pull this together. But I just am one of these guys where if you see a problem, I just need to fix it. You just need to do something about it. And most of the time it's just assembling like-minded people who have a conviction that we can do better. And then sort of a curiosity to say, so what do we do? How do we do it? And just invest the time. Look, I think at the end of the day, Neil and I are so blessed. We get to work together. We love working together. We love what we do. We love who we do it with. We've had some success in our careers. But at the end of the day, with that success creates a burden of responsibility. It's not all about just making money. I'm a pure capitalist at heart. Neil, and we talk about this all the time. We are capitalists. But, capitalists, you can sort of be imbalanced if it's all about just making money.
Right.
That is completely unacceptable to us. Our mindset is we have a burden of responsibility to make the community that we live in a better place. Whatever that might be. It might be in the arts. It might be in youth sports. For me, my passion has largely been inner city, trying to create opportunities for these kids to go to a better school, to have access to better nutrition and healthcare, to have mentors and role models, and just have an opportunity to move into middle class. But it starts with a burden of responsibility to say much is expected from those to whom much has been given. We've been blessed. A friend of mine used to say, we can't just be a catcher's mitt, where, we're just catching all these great opportunities. Sometimes you got to give back. And
well, we've made it one of our core values,
Yeah.
right? You have to be purposeful, not only in your work, but in your community. And we believe that really strongly, that we are blessed. You got to give back, right? And it's very fulfilling to give back, right? To us, it's part of our everyday core values of our company.
Yep.
So I love that. I think you guys have done a great job hitting on a lot of this so far. But as we kind of wrap up, clearly you're two guys that are very clear on what your values are, what you're passionate about career-wise. So on that note, what are, some advice you would give to some guys in our boat, late 20s, early 30s? I'm sure you'd be the first to admit that you've made some mistakes along the way, but how do you get to where you're going with this? You seem to have it pretty figured out.
We make mistakes every day, Jeff. Still, every day. I would say, we talked a little bit about this earlier, but conviction is one thing. I think being a student of the business, right? I think understanding the business. I think when the light bulb came on for me was kind of my mid 30s, when he's still a mentor of mine. He's still a guy when I have these kind of things in my head that I can't get out, that I call and say, okay, dude, how do I figure this out? And he never gives me the answer. But he said to me, you understand the business from our side of it. You need to now understand it from your client's side of it. Study the client, study what the client does, understand the client's business. And that goes for any industry, by the way, not just this one, right? But if it's like a Sun Tzu, right? If you know your enemy like you know yourself, you can attack. Well, if you know your client's business the way you know your own, it just makes it a lot easier to be able to be impactful on their business. So that's my advice.
I love that. I would say on maybe the non-business side, just a couple of reactions to your question, Jeff. One, to a younger person, look out, sort of raise your head and look out to see men and women who you deeply respect. You respect their integrity. You respect the way they approach problem solving. They may be in your company. They may not be in your company. And don't be shy to ask if they can mentor you. Neil just mentioned his mentor. When I look back, I had mentors throughout my life. I wasn't intentional about it when I was younger, but I look back and realize today that it was mission critical for me, for my own personal growth. The other thing I would say is, at the end of the day, you want to answer a question: what does success for you look like? Some people, success is just having a bunch of material things, cars, nice houses, sort of what have you. I will tell you right now, if that's what success looks like to you, you might achieve it and you'll find it completely unfulfilling. At the end of the day, and there's been research upon research on this, so I'm now talking in your question to a younger generation. At the end of the day, what will bring you the most happiness, the greatest health and fulfillment is relationships. Relationships at work, relationships outside of work. If you are running through life hard and you're not investing in deep, lasting relationships, you're going to find yourself wanting, when you get to be much older. I think the relationships piece, in fact, there was a study that just came out at Harvard where they studied relationships over 3 generations, thousands of people. And that was the biggest takeaway. The happiest, most fulfilled, most contented people were those that did not necessarily have the most money. They were the ones that had the deepest relationships.
Love it.
Gentlemen, I can't thank you guys enough for coming on the podcast.
It was so much fun. Thank you.
Yeah, we appreciate the insights and everything you've done for the Central Florida and the Orlando communities. Just a huge thank you from us.
Oh, awesome. What a great
Awesome.
opportunity for us to share our story. Thanks for having the interest.
Absolutely.
Awesome. Thanks, guys.